Clients are finding the economy just a little bit tricky at the moment.
Well, we've had two quite interesting budgets. The 2024 one was a huge one.
There are some good businesses out there that are surviving.
I think it's been a little bit unprecedented in terms of the amount of roofers that have been out in the market.
Private equity businesses, they want to make more profit.
Hello, my name is Anthony Boakes. I'm the head of tax for Wright, Vigar, and we're a regional firm of chartered accountants across the East Midlands.
Hello, my name's James Sewell and I'm Joint Managing Director of Wright Vigar.
And here we are today in the Lincoln City boardroom, sponsored by Wright Vigar, the Theatre of Dreams. I think the imps are going up, aren't they?
I hope so. Obviously, as we record this today, we're second in the league and sitting pretty. Hopefully, when you're looking at this video, we're still sitting pretty, fingers crossed.
Yeah, this may not age well.
No, we will see.
How are you finding things out there at the moment, James, with your clients? It does feel like things are a little bit tricky out there at the moment. What are you seeing with your client base?
Yeah, I think that's a fair comment, Anthony. Certainly leading up to the budget back end of 2025, there was a lot of hesitation from clients, a lot of people just pausing, a little bit of apprehension in terms of what was going to happen. The budget happened quite late in November, then we're into Christmas, and now we're back on the treadmill into January. A lot of clients are finding the economy just a little bit tricky at the moment. Obviously, minimum wage and national insurance is now in full swing. The increases that have happened there, certain sectors, leisure, tourism, hospitality, certainly those that are heavy with people, are just finding things a little bit difficult. So I think the things that they're doing, they ideally try and stay commercially astute, managing your resources as best as you possibly can, keeping your eye on your pricing models.
Well, we've had two quite interesting budgets sort of back to back. The 2024 one was a huge one. The national minimum wage changes, the NI changes, the inheritance tax changes. And then with this budget in 2025, I think it's been a little bit unprecedented in terms of the amount of roofers that have been out in the market. You know, the government are going to do this, the government are going to do that. And I do think that significantly hit business sentiment and delayed a lot of business investment decisions that would have happened otherwise.
I think so. I think the constant changing of rules and speculation and media, and it's hard, I think, at the moment. You know, clients that we deal with and look after, you try and you make decisions as best as you can with the circumstances that you've got. So it is just that the constant change of rules just makes it very tricky to plan. So yeah, it's tricky.
So is there anything positive out there at the moment? I suppose interest rates is a positive. They've been reduced again in December. I think the outlook is that they'll be reduced further in 2026.
I think so. I mean, yeah, I think a lot of the meetings that we've had over the last maybe couple of years, farming might be the last 3 years, it's our counselling skills are being tested. And I think it's very important in all walks of life to stay positive. So
I suppose you've got to consider, in light of the tax changes, you've got to consider your pricing, that the cost of your supplies, your buildings, your premises, and also whether you're using your staff in the most effective way, whether you've got the right staff levels, whether they're being used effectively.
Yeah,
they're all the sorts of things that good companies are doing at the moment and reviewing.
Yeah.
Talking about service-driven industries, one thing I did want to raise was how much PE, private equity activity we're seeing in the marketplace. Seems to be very few private dentists or vets that are now independently owned. They all seem to be part of a national chain. From my own personal experience, my vets, I think I've noticed a change since they've been taken over by a national.
Yeah.
Costs do definitely seem to have risen significantly.
Yeah. I think that's a very fair point. Those good businesses, sort of recurring income, obviously, we are independently owned and long may that continue. But there's been a lot of activity. I think certainly coming out of COVID 2021, things, and we don't want to be too doom and gloom, but we've mentioned that it's quite tough out there at the moment. And if business owners are to be offered a chunk of money to retire earlier or take a little bit of cash off the table, then you can potentially see the attraction to that And so I think there has been a lot of activity in those professional services. I think the byproduct of that is that private equity businesses are very shrewd, switched on businesses, and they want to make more profits.
Well, they're not in for it for the good of their health. They're into it to make a return, and often they want that return quite quickly, 3 years, 5 years, that they want to be, have packaged it off against the next private equity buyer.
Yeah.
I was going to ask, what do you think? What do you think the impacts are to the customers, clients of those businesses when they are taken over by private equity?
Speaking from experience on those industries that you mentioned, costs going up and service going down. Really, you mentioned levers. They're the levers that can be pulled. Now, in some cases, there are some benefits to be had in terms of maybe some economies of scale, maybe some better use of technology and those types of things. So to try and be balanced, it's not maybe all bad news. If you've got deeper pockets, you can maybe do certain things a little bit better. But I think in the main, we're just seeing, I think the service, as people try and make more profit, the service reduces. And as an end user of those types of businesses, it's just not as good.
And talking about M&A activity, in 2024, 2025, sales to employee ownership trusts kind of seem to explode a bit in the market. So for those people that aren't aware of EOTs, they allow business owners to sell their company to a structure that's owned by the employees, and it was completely tax-free, no capital gains tax at all. And we actually did there's been a significant law change, unfortunately, in the latest budget in November. So rather than it being a 0% tax rate, they've changed it to a fixed standard rate of 12% now. And we actually concluded the transaction about a week before the budget, and the client emailed me in a panic on the morning after the budget saying, "Are we okay? Have we got our deal through?" Unfortunately, we had. Real tangible tax change there to the EOT system, and that's got to have an impact on the marketplace for your EOTs.
Yeah, I think so. I mean, we've certainly over the last 2 or 3 years, there's been a heck of a lot of activity, and I know we've worked quite closely together on quite a lot of cases, probably off the back of what I mentioned around people just being frustrated, knowing that there's going to be some tax paying down the line. Actually, if that's what we're able to take off the table, we can retire, we can afford to live off that. So I think that stimulated a lot of activity, be it MBOs and sales to maybe private equity, but also this EOT system, and the fact that you could sell your business and benefit from a 0% capital gains tax rate and leave the business in the hands of the employees was very attractive. And we've worked on quite a few of those hybrid EOTs with MBOs and all types of structures. There's been speculation over the last few budget updates that there was going to be some changes, but I think this last change is quite fundamental, isn't it? And all of a sudden, that's just put a bit of a pause on some of the EOT plans.
It certainly has. I mean, that's certainly at the smaller end of the market. Yeah, what you'll be doing is you'll be getting your company into quite a complex management structure going forward, with a board of trustees that are running the company rather than a managing director.
And I think sometimes where we've seen the EOT structure, that the sort of the exiting owners have got to be prepared to take deferred payment, which has also it's fairly fundamental to, yes, occasionally there's some bank finance in there as well to help facilitate the deal, but yeah, it needs reasonably sympathetic exiting sellers as well.
Absolutely. So I think going forward we will see EOTs drop off. So clients have been looking afresh at all the other options, trade sales, management buyouts, family succession options. I think a lot of those options will come back onto the table going forward. And one of the changes that I did want to talk about was the big change just before Christmas that was sneaked out. The government, I think, trying to kind of not give full public visibility of could be another U-turn. The £1 million proposed allowance for business property relief and agricultural property relief, the family farm tax, as it's been called by the NFU, has been increased to 2.5 million. So that actually is really, really good news.
Yeah, I think so, Anthony. It was brilliant news. The 2.5 change was brilliant because over the last year or so, we've had a lot of meetings, some joint meetings where, particularly with farming families, where they've had to start getting their head around this huge change within their sector. On one side of the table saying, don't really want to pay any tax, but I don't really want to hand the assets over. Well, it's sort of, you've kind of got to do one or the other. There's been a course where they've had to get their heads around that. So when this law was announced this potential rule change was announced in October 24, we were told that it would take effect from April 26. So that provided a window of opportunity for farmers and businesses, but this is in the main, we've seen it with farmers taking action a bit more. They've got to get their sort of plan in place on how they manage this, which involved a lot of soul searching. I'm sure it involved a lot of sleepless nights, but basically the people, the generation that owned the farm and the assets had to either accept that they were going to pay some inheritance tax or they were going to have to give it away. And there were a few strings around that as well, around how long they had to live. So during that window as well, we went from having a £1 million allowance that couldn't be transferred to your spouse. There was then an update to say, actually, you could transfer any unused allowance to spouse. In the meantime, some people had already transferred assets, which in hindsight now didn't need to have been done. And then we've had an update. We've had another budget, but they didn't announce it on the budget. So we had some people that were holding fire before they implemented changes. As soon as we had the last budget, they were implementing changes between then, which was the end of November, and end of March, 5th of April, 26. And with hindsight, they probably didn't need to have done some of those changes. So now the fact that you've got 5 million between a married couple, I would say maybe 70% of our agricultural clients are okay. Maybe a little bit of planning, a little bit of succession work, but not maybe the wholesale changes that we're looking at.
There are, of course, still the bigger farms, the bigger businesses where they are still exposed to inheritance tax, and for a much larger business, that the 5 million allowance actually isn't going to cover a great deal, and that they are still potentially going to pay 20% inheritance tax above the 5 million threshold, and that's for trading businesses only, of course. The 5 million allowance and the 20% rate only applies to trading businesses. If you've got an investment business, it's 40% and there's no 5 million allowance. So people who have investment companies are still not in a great spot. The other thing we're seeing is some larger clients are looking at trusts, family trusts again in a big way. I think trusts probably became slightly unfashionable over the past 10, 20 years. But now they are very much back, and they are a way that the large businesses can be passed down the generations without so much inheritance tax. So we've got a few examples, but we've got one example where the client would have been liable for a 20% inheritance tax rate. They've settled much of their company into trusts, and as a result of that, the IHT rate's probably going to be more like 1 or 2% after 10 years.
I'm aware of, I know some of the work that you've been doing with clients on that type of solution, and the theory behind it is where we're putting sort of minority shareholdings into trust, we're able to benefit from discounts.
Yeah. So as long as the settler survives for 7 years, it's outside of his estate. But the inheritance tax system also has a 10-year charge for discretionary trusts. So a discretionary trust is valued at the point of 10 years, and then it pays inheritance tax at 3 or 6%, and depending on whether it's a business or a non-business asset. But like you say, by fractionalising the shareholding, we can take advantage of discounts for minority holdings, and it can get that rate down even lower to, well, we think 1 or 2%. So a decent saving.
Yeah.
Hopefully you found that interesting, and if any of those subjects are resonating with you, please do feel free to get in touch with us for a coffee.